In today's presentation, we're going to cover setting the scene, break-even payout, strategies for dealing with a low season payout, strategies for dealing with a high season payout. I want you to consider one strategy which is around having a debt buffer to carry you between the highs and the lows, and then just see if there's any questions. In terms of setting the scene, here's some Westland milk products from 2007 to 2014. Alright, so we started with a payout of $4.62 there. You'll see in front of you just a little wee article there from Stuff. Now the chairman of Westland Milk Products at the time, Ross Scarlett, mentioned this. Westland Milk Products has announced a healthy payout to dairy farmers of $4.62 per kg milk solids for the 06-07 year. This is 6 years ago. This is a healthy payout, $4.62. Who thinks that's a healthy payout at the moment? He goes on to say that it's well above expectations and one which suppliers are likely to be well satisfied. Then goes on I'll miss all the stuff in the middle because that's all junk. At the end he says, the company is now projecting full year returns for the 07-08 year in the range of $4.75 to $5. New Zealand dollar was a dark cloud. For the season ahead, probably the greatest single uncertainty. Who remembers what the 08 payout was?
Yeah, we do.
What was it, mate?
Last one ever, was it?
She was $8.
Yeah, last one ever, yes.
$7.99, so it's $7.99. So look, that's the forecasting. So we've got this huge variability. What happened the next year?
They took money off us.
Righto. The next year, which they had initially forecast at $6.60. So when they got to the $7.99, they did a forecast for the next year at $6.60 and come in at $4.58. So we've just got a lot of variability. Then we went to $6.15. Then we went to $7.70. So we were back up again into a good payout. Down to $6.04. What are we this year?
$6.20. 10, $6.20.
Be an optimist. 6.30.
Probably $6.40. We went down to 79 cents last
Where did we
time.
start?
Yeah.
Where did we start with the forecasting then?
Yeah, very low, wasn't it? Yeah.
Yeah.
In August 12 it was about $5 to $5.40. I was having a look at it then before. So again, a big difference between where it was forecasted and where it's ended up. And so it sort of says, hey, do we need some strategies to deal with this? Because we can start the season, we don't finish it how we thought we were going to. One of those strategies I was thinking about is, what about around averages? Last 7 years, average payout was $6.17. Last 5 years was $6.13. Not that different. Last 3 years is a little bit higher, $6.63. What's the next 3 years going to be? Right. By the way, when we got that $7.99 year, everyone was expecting $7. It was going to be $7 into the future. That's what at the time that was all the talk. There was been a structural shift in payout, and that's where it was going to be going out. Okay. So why look at strategies around payout? One of them, number one, it's actually not, and these aren't in order, but I mean that's number one important. But one of the reasons is to manage tax, and I'll talk a little bit about that as I go through. And then there's an example about why we need some strategies to manage tax. Number two, reduce stress. It can be awfully stressful in the years when we hit. If we go down to $4.58 and you work out that your break even. Well, actually, some of the break-evens are a lot higher than that, particularly when you're taking into account what the bank wants as capital repayments on debt, personal drawings, HP payments, what you actually need to survive. Well, you will find will be more likely around the average payout. And what happens in the meantime when you don't get that? And that puts a whole lot of, like at the start of this year, coming through the winter, there was a whole lot of stress around everybody's finances. That if we actually did some planning, particularly when we got the higher payout years, we might avoid some of the stresses of the lower payout years. So to actually be proactive rather than reactive, to actually figure out in advance that we're going to have a drop. We get a good year, thinks, well, yeah, which year's going to be the bad one? Because it's coming. Because it always is. And that's the same as any market. There's ups and downs. So if you think, yeah, you're at a good one, you've got to be thinking now, how am I going to manage the bad one that's coming? Oh, sorry. Number 4. If we can actually manage strategies around the payout going up and down, we'll actually end up with a better rating with the bank, probably, and achieve reduced margins, because some of their ratings are affected by, do you go over your OD limit? Do you have to go back and get your OD increased and increased? Some of those things affect your margins. What else? They're the sort of things, what else affects your margins? I mean, obviously your general assets and liabilities do, your risk there, but in terms of how you manage your business affects your margins as well.
General risk rating of the clients, obviously, if you manage that, it'll help.
Yeah, and if you can manage that and get a reduced margin, that will be good. And so in terms of trying to work out what is a good and what is a bad payout, where are you? What's your average? What do you need to survive? Dairy Base for 2012 had the average farm working expenses on the West Coast, excluding your own labour and depreciation, is about $4.55. Now that's before interest costs, it's before drawings, it's before bank repayments. All right. People's personal generally sits somewhere between 50 cents and $1. It does depend a bit how high your production is, whether you're producing 80,000 Ks or 150,000 Ks, or whether you're a big spender or a thrifty, but often between 50 cents and $1 you need for that. Between $0 and $3 in the debt, so I've got clients that are nothing, I've got clients at $3. Obviously the $3 one has some issues. But when I was looking at that included high purchase payments and everything like that. I was saying, what is the total that has to come out of cash flow for the debt? So that's all your high purchase payments and all your principal and interest to the bank and overdraft interest and stuff like that. So even if you're mid-range at the $1.50 there, $4.55 makes 50 cents makes $6.50. So where are you in that? Knowing where you are, again, and that helps you determine where you should be when you get the payout announcement from the dairy. You say, right, my cost is 5. That's what I need to survive. So if I've got to pay it at around 6, then I'm going to be up $1 per kg of milk solids. That's what I've got some stuff I can make some decisions around. And then, what's asset replacements in there that you actually need to keep your plant up. Right, some strategies for some low payout years, and this is like this particular one here. You all do that automatically. You're all, if your payout's tight, you all automatically go and defer some of your non-essential maintenance. And I'll put non-essential here because we don't normally try and defer stuff that's going to affect next year's production. So that's something most farmers just do automatically. Defer fertiliser claims, that's something we do as accountants. And this bring back any IRD income equalisation deposits, again, that's something we do as accountants. What we're trying to do when we do that is we're trying to even out these tax rates. So first $14,000 of your earnings is taxed at 10.5, 14 to 48, 17.5, 48 to 70, 30, 70 plus 33. Companies and trusts still get taxed around this 10.5 to 17 for a start, because if you're a company or a trust, we always allocate you out the earnings at least up to $48,000 because it's cheaper. Company rate at 28, trust at 33. It's still cheaper to get allocated it to you up to $48,000 of profit a year. So those personal rates still impact what we do with companies and trusts. The reason we try to equal it, if you take 1 year that the payout, let's say you produce 100,000 kgs of milk solids. 1 year if you make $28,000 on a low payout year, all right, you're only paying tax at 10.5 cents. Next year, let's say the payout jumps up $1.50, and we've seen how that's why I put that slide about how far it jumps all around. All things being equal, if you don't do much with that, it can just add 150,000 to the bottom line. Your costs are the same. You've just got 150,000 more income. So your profit that second year could be 178. And if we just leave it like that from a tax perspective, for the 2 years you will have paid 43,000. If we can use some mechanisms like that, and some of the other mechanisms that I'll cover through to sort of spread it to even it out a bit, the tax would have been 34. So over the 2 years you can save $9,000 in tax. That's why we like to try and see what we can do to spread between highs and lows. In a high payout year, we would do any of the deferred maintenance. We normally buy up the consumables prior to balance date, like fencing materials, drenches, fuels, detergents, AI, feed, that sort of thing. We normally try and buy them up before balance date if we think, hey, this has been a great year payout wise. Go and buy them up, because next year you're going to use them up next year anyway, right? I'm not talking about buying stuff you're not going to use up in the next 3-4 months, something like that. And then it's just something that won't go out of cash flow in a year that maybe are down. There is a limit in that as far as IRD is concerned. You can't have more than $58,000 worth of that sort of stuff on hand. Of course, if you're hard pressed to actually know what you had on hand as well. Accelerate certain capital expenditure, and that can be, accelerate certain expenditure. So you can actually prepay. If you were renting some land, if you were leasing land, grazing might be an example, you can actually prepay it up to 6 months, minimum of up to the greater of $23,000 for 6 months worth. You can actually prepay it. Right? And some other things like AI servicing, you can prepay your accounting for up to 6 months. You can prepay your farm advisor. You can prepay your rates. You can pay your full year's insurance instead of monthly. You can buy up mileage if you've got diesel vehicles. So there's stuff like that you can do when it's a high payout year and say, hey, listen, I'll just take it out of this year by buying up. And because it's two impacts. Number one, it spends the cash when you've got it. Number two, if the next year goes, the payout is down, you don't actually have to spend it because you've already paid for it.
And you're talking about deductible expenditure.
Yeah, yep, that's deductible. We don't. I know what you're saying there, Ross. Yeah, we don't advise tractors and stuff like that to even out payouts, because there's just no claim on that sort of stuff. You only get, you buy it in the last couple of months of the year. You might save yourself $500 in tax, and you spend 100 and whatever. We do farm development if we own the farm. You can do farm development in the high payout years, and you do less in the years when the payout isn't so high. That helps even things up. Also evens the cash flows. You do farm development in the good years. It's also producing increased production in a bad year to help you through. So it has a helping hand in the bad payout years. And I'm whizzing through that fairly quickly because a lot of farmers just do this sort of stuff. But I mean, certainly talk to your accountant about it and work out your strategies about what you're going to do there. And sometimes in a high payout year, we do put money into income equalisation deposits. We don't tend to use them so much when you operate in a company or a trust, right? And that's because you have one rate that you're basically paying, and as long as we can get you about the $48,000 of earnings each into your personal names, then we don't have to play too much with the income equalisation deposits. But we do sometimes if it's in your individual names. How about that one? Buy assets on HP in a low payout year. Here's a strategy for you. Why would you do that?
Because most of be paying it in the high year.
Yeah, it's because if you can afford it, because you want to be able to afford it in a low year, don't you? There's no point saying, hey, it's a really good year, I'm going to go and buy a new tractor on HP. Next year's low, you've got this HP $2,000 a month going out, and you've got a low payout year. You should be able, if you want to buy stuff on HP, you should be able to buy it in a low payout year.
Plus you should get a better deal.
Yeah, because no one else is buying them. Good. Good point. All right. Or alternatively, buy the assets for cash in a high payout year. If you've got the cash, that's fine. It won't help with your tax, but I mean, it does mean that in a low payout year, you're not committed to $30,000 to $24,000 of tractor payments. Just helping manage the ins and the outs there. Obviously, if in the high payout year, it doesn't help with tax, but if you lump sum off your debt, again, obviously it makes it easier in a lower payout year because you've got less debt. This is the one I wanted to have a bit of a talk about. Let's have a debt buffer. What I'm sort of proposing here is that you actually have a look at having a separate flexi loan of approximately $1.50 per kg of milk solids. All right. And this, I use a per kg of milk solids because obviously the buffer you need depends. If you've got more production and bigger farm, you actually your overdraft is actually bigger than a small 80,000 kg milk solid farm. So I've just worked it in.
Sorry, what do you mean by flexi loan? Isn't it?
A flexi loan's one you can draw up and draw down as you like. It's almost like an overdraft, but I'm saying it's separate. Right, so it might be, let's say 100,000 kg milk solid farm. It will be a $150,000 loan. You can pay it down, you can pay it up as you draw it up and down, just by as you like.
So is this as well as your overdraft? Or,
Yep.
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 And
And as well as the
revolving
term loan.
credit.
Yep. Revolving credit loan. Yep. If you want to, yep. Another terminology for it is a revolving credit loan.
Would this replace the term loan, or?
Yeah. Because it's
Yeah.
only for a certain piece of the debt. It's only for 100,000 kg farm. It's only for 150 of the debt. What it is what I'm proposing is that we can use this to manage the highs and the lows rather than have to go to the bank and manage it with overdrafts. Work out where you think the average future payout's going to be and be conservative, but you can look at the history like I've done there and look around there. But we always say be conservative as accountants because you get it wrong. Like it's all right to be conservative and get it and have got it wrong and the payout was better than you thought. You know, everyone's going to go great. But if you actually get it the other way, everyone doesn't go great and it's not so good for your management. What I was sort of saying there is when payouts over 30 cents over your estimate, look at paying the surplus above this level off the flexi. All right, get your flexi down. So if we end up, let's say we take it as we've got a $6 average, that's what we take it as, you know, and we get paid $6.50. I was saying, you know, we let 30 cents float because, you know, so we still have some ups and downs. We get to 6.30, but put the other 20 cents off the flexi. The idea being that we can pull it back when the payout's lower, and we can pull it back off the flexi ourselves. Basically, what it will do is it gives you $1.50 payout, $1.50 per kg milk solid buffer for when payout drops, and that strategy. And if we use 30 cents either side, it means the payout for you fluctuates by about 60 cents in terms of how it impacts your business. I think I've done an example because you can't really understand it much without an example. But let's say we started doing this in 08 and we accurately predicted the next 4 years at $6.12. All right, which it was. If we were when we hit the $7.99, we would have said, right, what we're going to do there is, because we said 6.12 was our average and we were allowed 30 cents of flexibility anyway in it moving, it gives us $1.50 to put off our flexi per kg milk solid. $6.49 stays in our cash flow. Right, so we're about 30 cents above our. Well, actually, we would have taken more than $1.50, but the $1.50 was the flexi. That's all I put on flexi anyway. So we left some more in our cash flow to end up at $6.49. The next year when we hit $4.58, we would have taken $1.24 out of our flexi account, and therefore, you know, we would have had, yes, it would have been a lesser year at $5.82, but it's not that much less in our cash flow. What I'm trying to do is get something that actually gets us around managing the ups and the downs, without resorting to the bank and saying I blew it all in the good year and I need to borrow in the bad year. And probably often in the good year, you blew it all on good. You know, a lot of people still blew it all on good things. I'm not saying they wasted it, but they might have done development on the farm and a whole lot of things that they just don't have the money now to get through there. 2010, we would have just done nothing because it was around the average payout. 2011, we got another $7.70 payout. We would have put about $1.28 of that aside, and we would have got ourselves out to about $6.40 still. So it was just a strategy I was looking at, trying to even the cash flow out. as opposed to taking, because the other option, of course, is that you just took a lump sum off you had a good year payout, so you paid a lump sum off your debt. The problem is with that is that next year's this. It's not so easy just to say, hey, can you give me that money back? I gave it to you last year when I had a good payout. Can you give it to me back? And yes, you've got a good relationship with the bank. Yes, you'll get it back, but not as easy as if you had the flexi and you just did it yourself. In 2012, we would have done nothing because we were about average. And 2013, I said 615 because I normally just budget the middle. I normally budget the middle of the range when they do a range like that. I normally just take the middle when we do our figures. Okay. So it's just in summary, there are some strategies you can look at because payout is going to fluctuate. I think it's that much more quicker now, and I think part of it's actually the Fonterra auctions because everyone knows where the price is going. As soon as customers start to see the prices going down, they start holding off their buying. It goes down sharper. As soon as they see the prices are starting to go up, they start buying more because they think they're going to miss the boat and pay more for it up the top. Drives the prices up. So this is actually got a lot worse. The up and the down. So I think that's, my sort of view is that that's here to stay. The ups and downs and how quick it is. Because the issue is we used to have ups and downs, but it could be 3-4 years to cycle, not 1 year high, 1 year low, 1 year high, 1 year low. So yeah, saying there are strategies we can use to try and smooth that. Again, it just takes planning, and that's what we've sort of talked about the whole way through. It just takes, if I come up with a heading for the whole day, it could have been it just takes some planning. Knowing where we are, just know it's good planning and knowing where you are. And that, in terms of that, you can come up with your own sort of model there of what you want and what you think would work for you. That was just where I thought was a reasonable level looking at the differences in payouts that have been over that period that I actually looked at.